The objective of Stocks Pe Charcha is there's a very famous Peter Lynch quote: "The person that turns over the most rocks wins the game." In our stock market investing context, rocks are the companies or businesses. Turning them over is doing research. Winning the game is finding winning stocks, which means companies which can compound well for many years. Now, this is a game of probabilities plus intellect. Probabilities first. So there is a general 5 to 10% rule of probabilities. So even if you are a researcher and an investor, generally if you study 10 companies in detail, you might get one which would end up being a compounder over 3 to 5 years period. So that just says that you have to turn over many companies in order to get your winning stocks. And as cycles change, again, you are in a situation where you have to be swift in doing a rotation within your portfolio. Else, generally, the winners of a bull market are laggards for the next 2 years. That has been a repeatable history. And most importantly, when you turn over many rocks across market caps, across sectors, we find those gems which typically institutions cannot find or they miss. So that is where the genuine alpha lies. So let's look at what has happened in Q2. But to begin with, let's look at what matters and where either we are happy or sad depending upon the recent trajectory. So quick observations over here. If you see Nifty 50, the biggest in the market caps, its 1 year return is actually 13% now. Okay. And if you look at, say, the small cap on the other side, it's almost nothing. So it looks like Nifty has beaten the small cap index returns in a healthy way over the last 1 year. What it hides is that last 3 years, Nifty gave a CAGR of only 14%, while small cap gave 22%. So for a long 3 year period, there was an outperformance of 8% every year, which compounds to a much higher number. Secondly, what also hides is the Nifty would have fallen only by 17 or 18% during the market correction from Jan to March, while the small cap 250 had fallen 28, 29%. Okay. So the fact that it still has no return means it fell 28%, which means it went to 72. And if it is back to 100, it means it has risen 40% from the base. So that's why it is always said that small cap, micro cap investing will have much more volatility. But if you turn around enough rocks, if you study businesses, and if you have the mindset of an investor and not a speculator, you can really, really make a big alpha where you don't really care about all these benchmark returns. So that has been our journey over the last decade or more. Q2 results, this I think most people are familiar either through their own study or those who have been attending our sessions. So in a way, end of 23 marked a high point of growths, you can say secular growths across the BSE 500 components. So there was a 24% in the quarter ended September 22, and the last double digit was in the quarter ended March 23 growth. These are top line growths. And then you see that there has been a string of single digit growths, and we still are in single digits in spite of a low base. So which means that we might be still a quarter or two away from getting into good sustainable double digit growths on the top line. So this has been a feature where the Indian private sector has had low top line growths, but they had relatively better PAT growths. So they were trying to squeeze the PNL, okay, on the back of a very strong balance sheet. But strong top line growth still evades most of the components of the BSE 500. Again, PAT growth, you see, as I was mentioning, the double digit top line growth strongly tapered off in FY23. But till the end of FY24, we had strong double digit PAT growth. Okay. But there is only that much you can do. All the celebrated CEOs, CFOs, CEOs, maybe for a year or two, you can squeeze the PNL more but later on, your PAT growth has started resembling a top line growth. So we really are looking for a revival of the growth spirits as far as the demand is concerned in many sectors. And of course, the caveat is that BSE 500 is not a complete mirror of the entire 5,000 stock universe. So there have been many, many companies outside this which have logged in 100% top line growths and more, and which continue to do so. But this is a parameter of the markets at the index level. So let's dive into the Q2 results. Nifty 50, of course, these are numbers where some of the heavy cyclical industries have been taken off. So Nifty 50 had a sales growth of 6% and a profit of only 2%. While you can see as you go down the market caps, the profit growths are much better. However, the you can see the sales growth still are single digits. In microcap, one disclaimer that there is one particular company which had around 20-25% of the overall sales of microcap index and which had no profit. So that has been taken off. So excluding petroleum companies, this is how it looks. So slightly lower numbers, but the small cap index sales growth just touches double digits. So nothing to celebrate here as far as top line growths are concerned. But as we see, as the market cap goes down, the profit growth percentages sharply go. So 2, 10, 25, 26. Why? Let's see it from a trailing PE perspective of the indices. So Nifty, which has had a single digit top line growth over the last many quarters, still has an index PE of 22. So you might have heard many fund manager videos over the last 1 year who have been trying to resort to calling the large caps and Nifty 50 as a safe place to park your money for the time being, because the small caps are going to be very small cap, mid cap, micro cap will be very tricky, volatile, and they might see a big correction. That happened and has gone by. But if you look at the ratios, even if you see 1 year average of profit growth of Nifty as 8%, and then you compare an index PE of 22% versus small cap, if you consider a 38% kind of profit growth, okay, and at 30p, the writing is on the wall that which is relatively more expensive. Okay, certainly not the small caps. Same for mid caps with a 31% profit growth. They have a 33%. So what it needs to be understood is trend analysis is very important with the right interpretations. Any number looked at in isolation generally will lead you to long results. And if we feel that experts who talk like that are doing it because they don't understand, it is not so. Every investor generally has a behavioral bias as far as their investing journey is concerned. So maybe it is their bias of where they want to participate, but they certainly know how to interpret the numbers like we are. So this is what an interesting column for you. How many stocks within this universe of indices have a sales growth more than 15%? Okay. So if you see overall, it looks healthy, but we are taken only 15%. So certainly, even if you take out the petroleum product companies, okay, let's look at slightly higher numbers. On the smaller indices, it is an average of 50% and Nifty 32. We can say that there has been a partial revival in some segments of the wider 750 index. With the microcap 250, the 500 becomes 750. But as we go forward and all the silver bullets which have been fired, including government capex, including income tax rebates, including GST reduction, etc., we should start seeing these numbers going up quarter by quarter, and we will be certainly tracking that and coming back to you on how these look quarter on quarter. Okay, so first we'll start with some of the results, and we will be covering a bit about some of the highlighted companies so that you get an understanding of various industries, what is happening. Many of us who chase small caps, micro caps, SMEs, we try to chase that particular company, its con call, it's what the management is saying in isolation, and then we try to look at the sector. But the fact remains that if the renewable space has boomed in the last 3 years and companies have gone up 20x, 30x, that is because of the overall demand and the way the sector was structured. Hence, there is no harm in looking at some of the sectors through the lens of what the larger companies are doing. And of course, in our presentation, we will have a long list of companies on the smaller caps, which we will be discussing as either promising or to be cautious about, as I said at the start. So first of all, try to understand this table. I know there is a lot of data and the font is not large. You can enlarge in your screen. This is the sales growth, which is easily understood. So this is Q2 sales growth percentage over same quarter last year, that is Q2 FY25. This is the PAT growth. And again, as you can see, just like the indices, the revenue growths are smaller and the PAT growths look large. Okay. EV by EBITDA is a standard valuation metric instead of just taking a trailing PE or something. And we have done all these calculations so that we understand that any growth should be put in a certain perspective. So other than the factors which led to that growth, it also matters where you buy. Many retail investors have an habit of which when they are doing exceedingly well, but after 2-3 years of high growth, generally the company would have reached a peak point in its journey, which will be reflected in its valuation, and that is the time to sell and not buy. So from that perspective, this particular, you can say, a collaborative exercise between all these is very important. So telecom, of course, has very less participants now, but Bharti Airtel looks to be the good space. If you look at EV by EBITDA 13, so I would like to say that a general thumb rule is up to 15, we can consider it's an attractive valuation. 15 to 25 is fair, and above 25, it is certainly expensive. So what are the triggers for Bharti Airtel to, at being a 12 lakh crore market cap company, to have a 26% sales growth and 65% PAT growth? Again, a high fixed cost business has a massive operating leverage. So big changeover from 2G users to 5G users paying much more. So low paying to high paying. Structural tariff hike. Now that there is a practical oligopoly in this sector, that is two main players. Both have got pricing power, and the ARPU has shot up from 233 to 256 across a base of 45 crore users. Okay. Similarly, as we all know, the broadband Wi-Fi segment of Bharti Airtel has been doing very well. So it grew 30% year on year. Okay. So there's an operating leverage, and more importantly, there was a debt reduction with high cash flows coming in. So the debt to EBITDA ratio has gone to 1.6 from 2.5 1 year ago. Adani Ports, again, decent valuation and good growth, 30% top line and 25% at the PAT level. So they have successfully transitioned from port operator to integrated sports transport utility. So the cargo volume grew at 12%, and they have aggressively taken market share from the government ports. Their all India market share is 28% for the ports business. But more importantly, on the non-port side, there is an explosion of business. So the logistics business grew 79%, marine services 237%, and international ports business grew 35%. However, we see that while the sales growth is 30%, the PAT is 25%. So why is it so? Because the EBITDA margin for the domestic ports suddenly expanded. But what has happened is the profit growth lower than revenue is because there's a higher debt. As we know, there's overall the Adani group, including Adani Ports, has been in a crazy expansion spree. So their interest cost almost doubled from 600 to 1,200 crores, which led to lesser operating leverage than what you expect at a 30% kind of revenue growth. The next sector is Ultratech Cement, the giant of this sector, which has a EV/EBITDA of 25, and while a sales growth of 20%, a PAT growth of 75%. So that looks very explosive for a large company. So let me state that for the cement sector, there has been a very low kind of H2 FY25. In fact, most of the year. So most of the results need to be looked at with a lens of a low base. But what's important to know is, and those who attended our cement webinar, cement masterclass, know that this sector is coming out of consolidation after 10 years. Okay. So it doesn't really matter that whether, over a quarter or over a year or over 2 years, how does it look? Any kind of, financial engineering would not matter. This is clearly is firing on all guns. So for Ultratech, the revenue growth reasons is, first of all, there was an 8% volume growth, which is not easy for a giant. The realization per ton also went up by 5%. Higher share of premium products, now 31% of sales. And while the urban construction was slow in Q2, surprisingly, the rural sales grew by 15%. So that's the advantage of a pan-India player of a big size. PAT explosion क्यों हुआ है? So for your information, fuel and power costs account for 30% of the overall cost for cement manufacturing, and there was an 8% drop. EBITDA per ton shot up by almost 25-26% to 966. And now every cement company has captive power generation to aid their manufacturing and reduce the cost. So the green power mix is now 42%. So that's very high, bringing in operating leverage. Next company, again a different sector, is JSW Steel. So JSW Steel has EV/EBITDA by 13 and sales growth of 14% and a PAT growth of 166%. So इसमें क्या हुआ है? So there was a record sales volume growth. As we all know, the steel prices have been very soft, not really going up. So what has happened is sales volume is up 20%, which is very good. Talks about the infra activity in India. But the revenue is 14% because the realization has dropped actually compared to the last year. Again, the exports are up 89% with a good capacity utilization, which gives the operating leverage. So there has been a clear input cost deflation, which has led to profits being up by 166% in iron and coal ore. Also, there is a low base effect of last year when they had a dismal quarter in Q2. Now let's look at another important, industry, which is auto OEM, M&M. So everybody who has been in urban as well as rural India has seen M&M coming out with some path-breaking designs. and some great, great looking cars with great features. So their revenue growth is 22% and PAT growth is 16%. Again, a slightly inverted ratio. So Mahindra has been firing on the twin engine turbo. Not only their auto segment has done well, but the farm business has also done well. So in fact, the tractor boom happened in Q2, where obviously due to good rains, the farm sector would have a high demand. So tractor business is up by 32%, volume growth explosion, and while the auto grew at 25%. While the profit only growing 16%, because while there was some operating leverage obviously in both these business, we know that Mahindra has recently entered into the EV space and they have launched array of models. So over there they are in an investment mode, constructing new plants, capex, borrowing. So that is where the cash burn is happening, and overall P&L operating leverage is not there. Then we go on to another sector which has been in the news in healthcare, which is hospitals. So here you will start seeing the heat of valuations. So Max Healthcare EV/EBITDA is already 52, and the sales growth being 25%, PAT growth is 74%. So these are the cases where we have to be very careful that in case we try to enter, is it the right time or not? Okay, because if you look at only the right hand side, it is dark green, 25%, 74%, and it would continue to do well. But the market has this habit of cutting all froth and respecting valuations from time to time. So what has led to the revenue growth? There's a volume growth of 19%. Obviously, the occupancy levels are also good at 77% of the beds. The international patient revenue has run up 25% this quarter, and it has a high margin compared to the domestic patients. The JP Healthcare acquisition added to the top line, and the Max Home and Max Lab, the two, you can say, smaller businesses, home services and diagnostics, also have recorded 20% growth. Amongst the PAT growth, there was a one-time 149 crores reversal of deferred tax asset. So adjusted for that, the profit is only 16%, not 74%. So this needs to be kept in mind that at a EV/EBITDA of 52, the revenue growth is 25, and their adjusted PAT growth is only 16%. Another, I think, hero of the last run, Trent Super Specialty. Look at the EV/EBITDA, it is 46, and you see a top line growth of 16 and a PAT growth of 11. So what has happened is, of course, in the last 2-3 years, there was an aggressive growth of Zudio stores. And now what is happening is there is very limited same stores growth. Okay. So this is what is called expensive growth. कि आपने जो last 3 years में stores खोले, अभी उनका same store growth बहुत nominal है. And the only way your top line is growing is through trying to put in new stores. Whenever you put a new store in a new location, it will add something to the top line because that sale was earlier not happening in your company. So SSG at low single digits, and Star Bazaar in fact declined by 2%, so which is a drag on the overall revenue. Profits, of course, we discussed. The depreciation is up 65% because of the expansion spree. Interest cost is up 26%, and hence the net profit margin doesn't look. You can say the net margin has actually contracted. That is the EBITDA, operating profit. So what has happened with Zudio is novelty in the metros is plateauing now. कि सस्ते में लग्जरी जैसे दिखने वाले कपड़े या अप मार्केट दिखने वाले कपड़े, that halo effect is gone now. So the place that they are trying now is tier 3 and tier 4. And one thing is for sure, that trend which was always trading at 100 plus E, and many participants were commenting that it will grow endlessly like that. It has never happened with any company, and it is not happening with Trend as well. Let's look at another industry. So we will look at United Spirits. It's a premiumization theme in liquor overall. So 37% is EV/EBITDA, 12% sales growth, and 43% PAT growth. So the volume growth is certainly happening due to one main reason. They have re-entered into the Andhra market, unlocking a massive consumption base. Premiumization continues where their brands in the segment prestige and above, like Johnny Walker and all, grew 12%. Now these premium brands are making up 90% of the revenue. So there is a reason why the EV/EBITDA is a higher multiple. This will trade at some premium. Also, surprisingly, the revenue from the RCB sports arm grew at 16%, which is a nice non-core boost to the revenue. So, as I said, due to the premiumization, the EBITDA margin continues to expand. It is 21% almost now, up 3% from last year. The debt-free status of the company allows operating leverage. And under the India-UK FTA, if the duties on the Johnny Walker brand are further reduced, then they can see a further margin expansion because that is a significant value of their overall sales. Now let's just spend a minute on this. So over here you can see the EV/EBITDA numbers don't have any particular range, just like the PAT growth. So if you see the top lines have some range, maybe 0 to 40, 50. The PAT growth can be 234%, 1300%, etc. And again, you have EV/EBITDA which can go up to 200. So I would request all of you to keep such a parameter always in your mind, that what is it that you compare the growth with. Just a great management commentary about the previous growth and another great commentary about the future growth is not enough. Just like the market re-rates companies when the first upcycle starts, they strongly derate companies when the down cycle starts. And we'll be covering such cases today. So I'll hurry on. Another Bahucharchit stock, Vari Allergies. So it looks like fantastic results, 70% sales growth, 133% PAT growth, and a reasonable EV/EBITDA at 90. Okay. So let's just find out what it is. So there has been a US exports arbitrage where you get higher prices and realization compared to sales within India, which has actually led to the profit explosion. The volume itself was up 37%. The module production was 2.6 gigawatts versus 1.9 last year. So that's a very good growth. But the US kicker because US generally you can charge 2x the price of other countries because they are desperate to have a China plus one strategy for especially solar related imports. Massive order book 47,000 crores. And while their majority of the peers are still building factories to build solar modules, they are already producing in gigawatts. So many advantages. Net profit growth is almost double of a big sales growth because the EBITDA margin has jumped to 25% from 17%. The cost of RM, which is polysilicon and cells, had crashed globally, and Vari is making the most of it. The selling price average is higher due to the US sales, and it is net cash positive, so interest costs are not really affecting its operating leverage. So enjoying a purple patch in the last 6 months. Bull cases with US customs. So what has happened is recently the US customs has stopped shipments of many Indian exporters to check whether they are including parts from China, which is polysilicon, cells, etc. Because they are giving these orders to Indian companies based on the China plus one strategy. Okay, and they know that for these wafers and cells, again, companies are dependent on China. So if the US customs creates a big issue and it really puts an embargo, then Vari's margins, which are 25% now, can collapse overnight, which is a bear case. If the US customs clearance continues, then we can enjoy such growth till the party is not over. And let us look at another cement company because Ultratech is a giant. Let's just dive deep. 18 is the heavy EBITDA, a decent 18% revenue growth and 276% growth. So again, important part in cement is just like a giant like Ultratech had good volume growth. JK Cements is also a fairly large company with volumes growing at 16%, which is much higher than the industry. The UP grinding unit has ramped up faster than expected. And the white cement and putty volumes are also 10%, which is a much higher margin business. So their expansion into Central and East India is going well beyond the traditional strongholds in North and South. PAT growth, again, a low base effect. Q2 FY25 was a disaster. They just managed to be profitable. And because of that, this percentage looks very big. Also, overall drop in the raw material prices and fuel and power costs. So all this has really helped to jump. Next, let's look at UPL. Numbers wise, looks to be in the sweet spot. EV/EBITDA of 10, 8% top line growth for a fairly fair-sized company, and 210% PAT growth. So double-digit volume growth, which is very good in key export markets. Domestic arm, in fact, saw a decline of 10% because in erratic monsoon and unfavorable weather, typically agrochemicals tend to pull back. The distributor inventory doesn't get sold and you can't bill further. So higher volumes, lower prices due to global agrochemical oversupply. That seems to be over because of double-digit volume in the key export market growth. Raw material prices, of course, fell sharply. That happens when there is oversupply. EBITDA jumped 40% year on year. Debt reduced by a mammoth 3,700 crores. So the good case is they could make money even when the prices are low, but the revenue couldn't gallop. So maybe another quarter or two, but UPL is certainly that kind of a company which can compound well over a long period of time. And it seems to be coming out of the sectoral down cycle. Another company in the heavy electrical equipment, GE Vardova. So look at the EBITDA, EV by EBITDA, 56. And then there's a sales growth and PAT growth. So this company has been a primary beneficiary of India's massive push to upgrade its power grid from thermal to renewable. And it certainly had a revenue growth of 39% based on the grid modernization push. So then solar park to be connected to the national grid. Supply chain bottlenecks cleared of the earlier quarters with respect to high voltage bushings. Export also grew fast at 30+%, and they contribute now 30+% of revenue. And they are moved to value-added products where gas insulated switchgear orders are much higher than the air insulated switchgear. While the profit growth very high, there is a EBITDA margin jump by 7% from 18 to 25, to clear operating leverage. And the company is in a seller's market, tons and tons of orders, so they have been able to prioritize margin accretive orders. So while the prospects seem to be very good, we have to be careful that whether it is already priced in. Lloyd Metals and Energy, industrial minerals, another sector. EV/EBITDA, which is slightly on the higher side, 26, but the numbers are sales growth of 154% and 90% PAT growth. So what Lloyd Metal has done is it has transitioned well from miner to manufacturer's transformation. So not just a miner anymore. 3 engines have been firing, record mining volumes which are up 77%. The new pellet plants generally have higher value sales compared to the earlier iron ore. Consolidation of mining contractor into own books. So they had taken a big stake in a mining contracting company, and almost 40% has come into the consolidated revenue. So this is the reason for the 154% jump. Most importantly, they have commissioned a slurry pipeline transport ore from mine to the plant. So this has slashed their logistics cost by 600 per ton, almost 70-80%. Of course, coming with a pipeline capex. So this is being viewed as a game changer for the industry, and something where Lloyds can always have an extraordinary profit compared to its peers. Interest cost has shot up because of this particular capex, which will give a decadal return. And the debt has also been taken for buying the stake in the mining contractor company. So that's why you have a 154% top line and 90% PAT growth, not clear operating efficiencies. Next, let's look at GMR Airports, Airport and Air Services. 29 is the EV/EBITDA, 47 and 86 being the increases. So it clearly has a pricing power and new revenue streams. While the passenger traffic declined by 3.5% due to runway maintenance of the Delhi airport, it could implement higher aeronautical tariff at the Delhi airport. And that's why the revenue there is 166% up. Recognized revenue from direct takeover of duty free and cargo operations at Delhi. And the Hyderabad airport is also gaining in momentum in higher traffic as well as price increase. Next industry is Vishal Mega Mart, diversified retail player. Again, a high EV/EBITDA of 35, but doing well at the growth levels. So the revenue growth of 22% contributed by good same store growth, SSG of 13%, which is very healthy for this industry, for established player. Early festive season where Navratri, Durga Puja came in second fortnight of September, added 28 new stores in Q2. The point is when you are already having a good SSG, then new stores are most welcome. You're not just depending on them. And its own brands, which the private labels have a 75% of the total mix now, which means they can control the supply chain, price, margins, and they can certainly compete with the other brands. PAT growth is double of the top line growth because of own high margin apparel being 75% of the mix compared to lower margin FMCG. EBITDA margin is up by 2%. And of course, there is a mode of operating leverage, which is very clear in retail. Operating leverage and leverage is very sharp. Last on this part is persistent systems. Again, a surprise package over the last 1 year when the market has not done well. It has continued to do very well. 38 EV/EBITDA, and there are reasons for that. 24% sales growth and 45% PAT growth. So what has contributed to this great sales growth? So the BFSI segment applications grew 30%. So they are winning large digital transformation deals instead of just maintenance contracts for existing installations. It's an IT services company, mid-cap IT. US growth steady at 15%, but more important, Europe exploded at 38%. So all these IT companies had started off by first getting great contracts in the US, but you see that Persistent has very clearly done a successful diversification, reducing over-reliance on the US market, which is volatile now and will continue to be volatile. The healthcare and life sciences degrowth has stopped. That was a drag on the revenues. It is growing now. And the total orders is already 5,458 crores for a mid-cap company, providing good visibility for the next 2 years. It has a record 22 consecutive quarters of revenue growth, which is very rare. And of course, the EBIT margin has shot up to 16%, up by 2.5%. And there are many operational reasons for that. We'll not dive in. But the forex gains have also been there. And there is an offshoring shift which has led to reduced cost and operating leverage. Let's look at small cap 150. So let's look at another, we can say other sectors now. So let's look at home first finance. Decently valued, you can say, and good growth. So what is happening? So the EBITDA has jumped to 15 from 8.1. Sorry, home first revenue is 28% growth. So the AUM itself grew at 26%, which is very, very healthy. So it's affordable housing finance is one of the main tickers. Challenging macros, but the company has continued steady disbursement, and a substantial upfront income has also come from selling pools of loans to banks, which is called direct assessment. So balance sheet also becomes light and there is immediate cash flow. So this is a smart move that they have managed to do in the last 6 months when the macroeconomic environment was not great. PAT growth, they have maintained high yields of 13% because of the focus on affordable housing segment. So in the affordable housing segment, you can charge much higher interest rates compared to prime borrowers who have a long credit history. Reduced borrowing costs. They've got a credit rating upgrade and diversified their funding sources. And there is the operating leverage where the cost to income ratio is now 32 versus 37% same period last year. So credit cost has also got control. It is higher only by 50 basis points. So overall looks to be a healthy play, and it depends on how various factors align now for the future growth. Next, let's look at one consumer company, which is CCL Products, mainly in tea and coffee. So again, consumer companies are never very cheaply valued. You will not find EV/EBITDA in single digits or 12. So it's 22. But if you look at the sales growth, it is 53 and the PAT growth 36. So this we can call as a volume-led breakout where a massive 25% volume growth has happened, which has beaten the industry average significantly. And they have done well both in bulk exports, which is B2B, and domestic retail. So they have a cost plus model for large B2B clients. So in the last 1 year, when the coffee prices exploded to historical highs, they were able to pass on these increases to the customers. It has also helped by adding to their top line, where for the same quantity, you have got a much higher price and a much higher revenue. The Continental Coffee brand, which we see in force now, has crossed 100 crores revenue in this quarter, gaining significant market share from incumbent brands of South. The established ones like Nestle, HUL, and also growing rapidly in non-South markets via e-commerce and quick commerce. The PAT growth is now 36.4%, where the margins actually got compressed, but the EBITDA per kg improved. So what we see is that as the coffee prices, which have started to soften, we will see another explosion at the, we can say, operating margin level and then at the profitability. So it seems to be on the cusp of a good upside. These are the Q2 results of some of the microcap companies, what we liked. And as you can see, most of the valuations are in a range which look pleasing to the eye, not very high. And you can see the profit growths have been generally very, very good. So we'll not cover each company in detail over here because we have a lot to cover. Now let's look at a quick snapshot of how the sectors have performed. So what we have done is the 750 universe, that is Nifty 50 to microcap 250. We have plotted the number of companies within each sector that has been defined and how many companies out of them have a PAT growth more than 10%. So you can get the refrain that cement and cement products, non-ferrous metals have done exceedingly well. Next is minerals and mining, automobiles, telecom. We discussed Bharti in detail. Transport and infrastructure, 75%. IT services, surprisingly, 73%. Because, we had felt that there was a lot of negativity about the IT companies. But if you look at the mid-cap IT companies, there are very good opportunities there. And certainly at an overall level also, this is much better than what is the perception. So then you have beverages, healthcare, and so on. Which are the laggards? We can start. Is personal products, textiles, and apparels. Textiles, we have a bit of an idea. We have been covering since the last 1 year. So actually, the textile and apparels had come out of the woods in terms of profitability in FY25. But then many of the companies have a fair bit of exposure to US exports. And what started after Jan 25 with the utterings of the US president, it has just thrown the textile currently in a tizzy. Also, when some of the companies are in expansion mode, it really doesn't help that you don't have assurance about the top line. Because that is the first thing that is needed in expansion. Profits come later. Then capital markets, again, slower growth. And we all know that these have had a strong bull run in the last few years. So have to be very careful while indulging in these companies, because even now the valuations are at a high and you've got PAT of only 33% companies more than 10%. This is also a base effect that since the last couple of years, the profits were so high that anybody who has been studying companies quarter on quarter for a few years realizes that just like in cement, etc., the base effect is low, is helping in a big way. So capital market companies, the base effect is so high. It's simply not possible that you can keep on growing at a adventurous pace every year. Banks, we of course there has been a stock, but we feel that banks and NBFCs are certainly to be deep dive. We have been doing it for the past few months. So this is the so what is important to understand over here is not only which sectors are doing well, okay, which sectors in this category don't have a great number to show now, but in the next few quarters, they are likely to fire. This is the essence of investing, growth and value mix. If you keep on betting here, maybe in a year's time or a few quarters' time, these certainly will stop performing at this rate and there will be derating that is. If a re-rating is likely to happen, it is on the right side of the chart. So we cannot have a plain Jane approach to what is good and what is bad. Cement, we have, I think through JK and Ultratech, we have already discussed what the sector is going through. It is certainly in an upcycle. But more importantly, again, as I explained in the last slide, with these kind of numbers, if you have to come down to a company that you need to invest in, how would you do? सब कुछ अच्छा दिख रहा है. जो बड़े हैं उनका परसेंटेज ग्रोथ कम है, जो छोटे हैं उनका बहुत ज्यादा है, कुछ लोग का तो समझ में नहीं रहे the top two. Okay. So just as an example, I'll share 2-3 cases. Orient Cement. Adani effect is coming into play. Adani has been buying companies left, right, and center in cement space. So cost resetting has been done, and a better branding with Ambuja and all is happening, which is allow it to have a premium price. And as we had analyzed in our cement sector webinar, even a 5 rupees or a 10 rupees increase in a bag of cement can lead to explosive PAT growth. For your information, combined over the last 10 years, many cement companies have still not had a cumulative 10 to 15 rupees price increase after 10 years. So that is what it can help. India Cements has undergone a takeover by Ultratech, so that effect will come in. Already has gone from loss to profit. Debt reduction has happened. Asset cleanup has happened, which means the factories which were not performing, bad assets have been taken care of. And then you have JK Lakshmi Cement, which is an operational turnaround, and Nuvoco Vistas, which is in the east. So east traditionally had the lowest cement capacity, and as the capacity ramp up and demand grows over there, Nuvoco Vistas has turned around in this quarter from a loss-making quarter last year. What happens in minerals and mining? So we have the 4-5 names that you see. So what has happened over here is global commodity prices have been soft. So the reasons for these growths have certainly not been simple price increases, but these Indian miners have delivered growth through aggressive production ramp-ups and internal cost efficiencies. And the slurry pipeline we discussed for Lloyd's Metals. Gravita has decoupled from mining risk by focusing on recycling and reducing share of lower margin lead and increasing recycling share of aluminum and plastic, which has a higher margin. So these are some of the things that have happened. When it comes to non-ferrous metals, it's a Goldilocks scenario as per our analysis. Rare combination of rising global prices and stable rising global domestic demand. Unlike steel, which is facing pricing pressure, non-ferrous metals saw synchronized price rally in Q2. Copper has been the outperformer with double-digit price increase YOY due to the supply disruptions in South America. Aluminium also had a steady rise of 6 to 8% and zinc 6%. So Hindalco is a story of volume plus price gain. Nalco 39% YOY jump in aluminium sales volumes. Hind Copper price rise beneficiary of copper. Hindustan Zinc volume drops, but price rise ensured profitability. In the defense, the things are not as bad as what you see over here. It's like a classic tale of two cities, you know. एक बहुत अच्छा और एक बहुत बुरे, exactly divided into two, okay, which is aerospace and defense. So we have done a very detailed defense sector webinar for 4.5 hours, where we have looked at what stage it is and where are we going, what value unlocking has already happened, and what massive value unlocking is yet to happen. But just to complete the Q2 part of what you see in red and green, okay, the good structural story of defense is intact, which is reflected in the strong order books. The execution in Q2 has varied wildly, which led to these numbers. So just for everybody's information, a quarter, I mean, it's a habit of analysts to, have a overpowering gaze on a quarterly results and draw conclusions. But in a company's life cycle, a quarter is a very, very small, tiny time period. Generally, years make more sense than quarters. But we'll continue with where the numbers seem very, very off. So MDAR Technologies at the bottom, the delay in closure of sales due to some tariff discussions around contracts. This is only a temporary deferral. Zen Technologies had a high base effect. Q2 of last year had a massive one of revenue spikes, never going to be replicated. So again, things are not as bad. Astra Microwave, supply chain issues led to subsystem related delays and delay in their sales, which is over now. So we'll have a better quarter in Q3. Bharat Dynamics, Q1 was a disaster. Actually, they couldn't do a lot of billing. So that's why it's just a catch-up billing of Q2 that has happened in Q1. So if you see, the moment you delayer a bit, you realize that जो रेड है वो उतना भी रेड नहीं है और जो ग्रीन है वो उतना भी ग्रीन नहीं. Auto ancillaries has been the talk of the town over the last couple of quarters, and we have seen meteoric rises in profitability as well as prices. If you look at the right hand side, then even now the EV by EBITDA, you see two clear groups. At the top, you see good growths with reasonable EV by EBITDA, and then in the second half, you see higher EV by EBITDAs and tapering growths. So what has been one of the key features of this industry structurally for growth? Upgrades in cars, which we all have been experiencing. Touchscreens, LEDs, sunroofs, alloy wheels, furnishings, fittings. So value sold per vehicle by each company like a Uno Minda or Lumax or Sansera, Gabriel has been much higher. Okay. So it's clearly a premiumization theme just like alcohol. And in this quarter, there was an export revival where large orders from global OEMs were serviced. Jewelry sector, there was a customs duty trigger last year where the gold imports duty was slashed from 15 to 6%. And this certainly reduced gold prices and led to a volume surge. But more importantly, what we could analyze in H1 of this year was the stud ratio jump. So the percentage of diamond studded jewelry in total sales mix compared to only gold ornaments has gone up. So that's a 36% revenue jump for stud ratio, while gold has been in the 20s. And again, there was a festive shift towards the second fortnight of September, which has accelerated some buying in all these categories, which are certainly have a snob value. On the hospitals front, the sector is clearly, in the mid to peak of its execution of capex, and the capex will start bearing fruits in the next couple of years for many companies. We are late in the capex cycle. Most stocks are trading at higher multiples than a couple of years back, and seem to be priced to perfection. Little room for error. Now, this is an important sector because it's not easy to analyze, and we have a YouTube video on the top banks. We started over there. So what is to be seen over here is the price to book replaces the EV by EBITDA, which is the right way for valuation. And if you see even the largest banks, which have a decent, standing in the market, their price to book is still less than 3. And you will find many pockets of opportunities where even they are less than 1, less than 2, less than 1.5, and they are doing very well. So this certainly requires a deep dive. But if you look on the right hand side, that's why we see that PSU banks are a value buy. The PSU bank index has done pretty well in the last few months because overall you will find the valuations very reasonable, the growth good, the credit cost and the various parameters that are there are all getting better and better. So this side seems to be better than this. Over here, the smaller banks and NBFCs might hold better opportunities. On the textiles front, again, results don't look very great other than the top 2 companies. And Pearl Global, we had analyzed about a year ago, also taken a position, but then due to the uncertainties, there was a problem. And very happy to see in Q2 they have bounced back with sales growth of 9 and here 18%. Kitex Garments, we have a full-fledged video on this, where the kind of ramp-up in expansion that we're doing, it was not understood by us, why they're doing a 3x capacity with so much uncertainties around US because majority of the sales are in exports and that is clearly reflecting in the numbers. So, of course, what needs to be understood is all this red can turn green in a matter of 2 quarters if the US trade deal goes through and there's a clarity on much reduced tariffs on the textiles being exported out of India. So Thanks for your patience, and I'll stop over here. Hand it over to Manthan to take the next part.
Yeah, thank you so much, Kaustav. Right, it was insightful. I hope like all the participant was already like got a gist of like how Q2 earnings has been there, right? And we have covered a lot of sectors. Some of them are in the late cycle, if we call them, but some of them might start like banking, financial, then textile might turn around if from tariff news shortens or we catch the trade deal. And in some other sectors also, we can think like few industries where certain sectoral tailwinds are there. Just give me a minute, yeah. So we will cover three sectors in this session. One is recycling, then premiumization trend as we have discussed in alcohol in autos, then our dairy company, which is again a proxy to the protein trend. And again, this is also a industry which is growing at a very fast pace. And so like what's happening in the recycling theme here is the government is favoring the recycling thing, basically the recycle of the metal that we use. So government has introduced EPR responsibility. So now manufacturer need to take the responsibility of their products at the end of their useful life. So basically what we'll do, like there are a company like Pondi Oxide, which will recycle the material and sell the EPR credits to the manufacturer. Right? And this has been the policy that has been implemented in 2008 first time, but again the expansion has happened to batteries and the plastics in 2022 for batteries and plastic for 2016. Then there is again a new thing in this. The battery thing has been so disposal of the batteries, both including lead acid batteries and the other part. So this BMWR policy is also favoring fuel recyclers, right? And the compliance target for the producers for FY26 is again 80%. So most of the time, around 80% of the production that they are making, they need to process them. So again, it's a very big tailwind for the company like Pondi Oxide. Until FY27, it will become to 90% for batteries. So portable battery will be 90% and electric vehicle will be again 90%. And for industrial and automotive, which is a lead acid batteries, it would be somewhere around 60%. But as of today, if we look at it, there is hardly any batteries which are being recycled, maybe a couple of years back. But now this trend is moving from unorganized to organized. Then the new GST reversal mechanism has also been introduced by the government. So receiver make the payment to the supplier with GST, and then supplier deposits the GST to the government. What happens is, so if like डायरेक्टली जो ये रिवर्सल मैकेनिज्म है जीएसटी का, इसके अंदर जो डिपॉजिट्स होंगे जीएसटी के वो डायरेक्टली गवर्नमेंट को यहाँ से देंगे, एंड जो सप्लायर को विदाउट जीएसटी पेमेंट कर सकते हैं. अगेन इट्स स्लाइटली कॉम्प्लेक्स प्रोसेस, बट अगेन इट्स एक्टिंग एज अ की टेलविंड इन दिस सेक्टर. So the first company that we will look in this segment is Gravita India. As we have discussed in the result section also, this company has been highlighted. Therefore, we have been doing a deep dive. So this company is mainly into a lead processing, lead recycling theme. So around 87% of the current revenue is coming from lead, 9% is coming from aluminum, and 4% is coming from plastics. Recently, they have introduced rubber as a segment. And if you see this light green, this will take care in the future. And in the rubber processing, we already have a company called Tina Rubber, which is listed. So what the company is saying, like currently only 35% of the total material is coming from organized sector, right? And the company is expecting to shift, 90% would be from organized sector in next 2 to 3 years. So again, it's a very huge tailwind in India that will be there for battery waste management rule that is coming, BMWR, that we have seen in the last slide. Right? And if you look at their 2029 KPIs, right, they are expecting to grow at around 25% volume CAGR. Profitability growth should be around 35%. That's how it came on our radar, because the management is guiding for about 25% CAGR growth in both top line and bottom line, right? And it's still 2029. And return on incremental capital is around 25%, right? And not lead revenue, which is currently only 13%, they want to increase it to 30%. Additionally, they have also been working on to introduce the energy need, like so 30% of the energy requirement will be through renewable, and they want debt-free balance sheet by 2029. And on the rubber, the Concall extract that we have taken while we gone through this Concall, Q2 Concall for this company, they mentioned that rubber, the recycling of the rubber is also very fragmented industry right now. Right? And recently the API credit has been introduced. And earlier, 90% of the total capacity in rubber recycling was in the unorganized sector. Right? So इससे क्या हो रहा है ना, जो पुराने जो भी ये unorganized player है, इनके पास technology was like quite old. It's like they are using only continuous pyrolysis and other plants that has been used in unorganized sector. So अभी क्या होगा, EPI credit आने से ये जो companies like Gravita, Tina Rubber will increase their capacity with a better technology. तो उसके कारण ये जो unorganized से organized का shift भी it's already visible and will continue in future also. So that's how like company like Gravita and Tina Rubber comes on our radar. Then again, a similar company, Pondi Oxide, that we have seen in the first slide, right, where we have seen the government push. So the company Pondi Oxide manufacture recycle lead, plastic, copper, and aluminium. And again, it's a decent capacity that they have, like we have listed here. And most of the revenue is still coming from like export for lead. Right? Plastics is 100% domestic, and copper is again domestic, and aluminium is only on domestic side. And one key thing about aluminium is most of the aluminium can be easily recycled without any degradation in the quality of the aluminium. अगर हम देखेंगे तो ग्लोबल लेड एसिड बैटरी मार्केट जो है वो अराउंड 4.4% से ग्रो कर रहा है, राइट. एंड द लेड एसिड battery segment is still in excess of 3% globally, and in India it's still growing at 6%. Right? So there is a lot of nuances like which like we think like with the introduction of lead lithium ion battery, like how will lead acid battery will walk around, but lead acid battery has its own uses, and its growth is still around 6%, which is not less on a very high base, right. And overnight, lead acid battery cannot be changed to lithium ion battery because a lot of restriction and constraint in usage of lithium batteries. So जब हम किसी Concalls पढ़ते हैं, right, we get a lot of understanding, and we also get to understand what's happening in the industry. So right now, the next 8 to 10 years, the lead acid batteries will definitely here to stay. That's what Pondi Oxide management is guiding. And our assessment is also like lithium ion battery will be used in some cases like electric vehicles, etc. But lead acid battery will continue to grow in industrials and other segment that is there. So overall, again, the recycled plastic market is also around 6.3 billion by 2030, and it's also going at around 5% CAGR. So what company is guiding for 2030? So they are also targeting 20% revenue growth, 20% profitability growth. Right? They want ROC of around 20%. So current margin is around 7%. They are guiding for 8% EBITDA margin and plus. So we have profit growth, volume. Basically, we will have a revenue growth. Then there is a chance of EBITDA margin expansion, and then this will kick in the much higher profitability growth. So this looks very interesting. Now let's move to the alcohol sector and how the premiumization trend is happening in the alcohol sector. So अगर हम results देखेंगे, beverages company, which is basically alcohol companies, so we will see like most of the companies, like the top 3 companies that we want to cover, is basically growing at its fat greater than 30%. Right? And revenue is only growing around maybe for, in general rule, if you see sales growth is X, profit growth is 2X. So we can clearly see margin expansion happening in this sector. Right? And this has been the case in a lot of sectors, but we need to understand how much time it is sustainable. Right? So companies like Allender, Blender, and Radico Khaitan, they are still guiding for more margin improvement as the production mix increases. So in alcohol sector, there is basically three. It's a mass market alcohol bottle that we sell. Then there is prestige. Then there is prestige and above, right? Which includes premium and luxury bottles also. So in India, that market is growing at around 11-12% CAGR, and the few companies are saying that can increase their premium PNA, prestige and above segment with greater than 15% CAGR. And the realization in that segment is much higher than the mass market base that we used to have. So now India is drinking premium alcohol, right? And that's what we can clearly see in the results of the alcohol companies. And still, we think the margin expansion can happen from this level also, and this will continue to the next 2 to 3 years at least. So let's look at the few companies, Concalls. On the United Spirits, basically the company is saying coming to the Indian single malt. They have an Indian single malt brand called Gold One, right? And they've said this is a very good quarter. This Q2 has been very good for this specific brand. Right? So they have been like launching this into the export segment also. They have launched a new experience like Darbar environment. So sorry, Durbar evenings, right? And they are also launching the aspirational, so limited collections of Gold One variant, right? Which is which will be used in the export market. Right? And so basically all these things that you see, like this launch has been the true representation of Indian artisanship on global luxury stage. So what United Spirits, again it's owned by Diageo, one of the leading alcohol companies in the world, and RCB is also owned by them. So they are launching Indian whiskies in India and then taking it to the export market. So this can further increase the average selling price per bottle for these companies. Even in Radico Khitan, if we look at it, they are guiding for 20% volume growth in a consumer segment. Right? In PNA, again, Prestige and above is strong double-digit growth. Right? And regular is also growing double-digit. And management is guiding for 1.5% EBITDA margin improvement in 26. Right? And they have guided like after this FY26, 1.25% can continue for next 2 years. And the margin should reach somewhere around 18-19% by FY28. So that's the guidance that Radico Khitan is giving. Now, if we look at the allied blenders, right, they are also saying that our Prestige and above, PNA above category is growing at around 28% year over year on volume basis. Right. And their gross margin has increased from 37% in FY24 till already at around 44% in H126. And it is projected to go above 45% in FY28, and EBITDA margin, see, like the EBITDA margin has grown from 7.5% in FY24 to 13%, should go to around 17% by FY28. So that's the kind of EBITDA margin expansion that is happening. Volume growth in PNA and above segment is certainly coming, which will lead to sales realization, improved sales realization per bottle, and then bottom line should grow at a much higher pace. So in any correction, if you find certain companies, I think this could be the one sector that need to look closely. Radico Khaitan has certainly done well in the past, but the companies like Allied Blender should be on radar. Then again, there is very interesting company named Associated Alcohol. We have been tracking this company for the last 2 years, but there is a certain issue with this company. It's not a red flag. The only thing is their share of IMFL proprietary. So this one, if you see in the black, this is only contributing on 16% to their total revenue, right? But their growth has been fantastic. So on 5,000, they have already reached 1,000 crore base, and in H126 they have around 520 crore of sales. But recently the growth is coming from ethanol segment, right? That's why market is not re-rating this company. Again, they are incrementally focusing on IMFL business, but this will take time because they are expanding their presence to the new states like Uttar Pradesh and Karnataka, and they have recently entered Uttar Pradesh and Delhi and all they are focusing on. Recently, it used to be a bottler for United Spirits and Inbrew, and they used to be a Madhya Pradesh player, but now they are moving to the new state and trying to be a pan-India player. So this journey will go through some pain in the numbers, but the focus of the management is in the right direction. So maybe 3 or 4 years later, if the IMFL proprietary segment starts contributing somewhere around 30-35% in their entire top line, this company can also could also be very interesting. So that's all about alcohol. As we have already discussed, premiumization is also happening in the auto sector, and there is one company named SGS Enterprises which is riding this wave perfectly. So earlier, and these are basically providing the aesthetic solution provider. So once the car is made, this company's product is mainly used in the aesthetics parts. So illuminated logos, they are actively working on in more electronics, right? And these will be the much higher realization products. So what happened in this company is, right, they had a legacy kit of per vehicle contribution somewhere around 1,500 rupees. They have acquired a WPI, which have increased the per value contribution to 3,000 to 5,000 rupees. Now they are working on a newer technologies like illuminated logos, etc. And they are also working on a touch glass screen. Right? And these kits will increase the per vehicle volume to around 4 to 6x. So this should be somewhere between 15,000 to 20,000 per vehicle. Right? So that says a lot about the company. They are on the right side of premiumization in the auto sector. Earlier, most of their revenue used to come from two-wheeler segment, right? But now, if you see, they have certainly around 38% is coming from four-wheeler, which is a passenger vehicle. Recently, they have also moved into the consumers. Consumer is basically washing machine, AC, right? So they are also building some aesthetics products for those verticals also. So what management says is their products uh, are not necessary should go into automobile sector. They can be used in the consumer segment also where aesthetics matters. So that's the company that we think, and this company is growing. It's showing like the growth for around like 23 quarters now, and they have guided for sustainable margin of 27% EBITDA margin. And incrementally, they are also focusing on the export market. So currently, only less than 10% of the revenue is coming from the export, but by FY28, this management is saying of increasing the export share to around 18 to 20% of their total revenue. And they have been acquiring a lot of other companies, sorry, a lot of other customers. They have recently onboarded Hero, I think. Right. So this company is acquiring the technology, they're acquiring the products. So they have done a JV with one company for this cover glass, right? And increasing their per vehicle sales that they can do. So I think this company should easily grow at around 20-25%. EBITDA margin expansion need to be seen. It will be tricky, but in terms of correction, if you find this company, I think this company could be a good bet if you want to take in the auto sector. Now let's move to the new company, new industry, which is again dairy, could be a proxy to protein. As we already know, in India, the protein culture is exploding. Right, few unlisted companies are even growing at around 70-80%. Right, and even the listed players, Parag Milk's new age business is growing around 80% year over year. Right? We have seen the growth of Country Delight. We have basically seeing the growth of Milky Mist, right? And their IPO will also come soon. So this company, as we already know, the lot of whey, the whey protein, if someone is consuming, the earlier lot of whey used to get imported. But now at the scale of Parag Milk, they was already into the cheese manufacturing and whey was their byproduct. So now they are using whey, which was their byproduct, to manufacture whey protein. So that's the thing. And in the medium term ambition in next 2 to 3 years, they want to increase their new age business contribution to the 20%, which is much higher business than the current EBITDA margin business of 8 to 9%. On the Amul entry into the protein segment, management is basically saying this will help in educating the customer and more awareness towards the protein side of the dairy. So management is guiding for double-digit margin. So current margin is around 7.5%, right? And management is guiding for double-digit margins. They have appointed Deloitte as an auditor. They have restarted Concall after 4-5 years. Right? So that's how the company come on our radar. Business is growing well, right? And the incremental share from new age business could lead to the re-rating of this company once our street is aware about the incremental margin that company is seeing. So now let's look at the different set of companies. So currently we have covered the companies which had a sectoral tailwinds. Right? Sector is helping them. Now we will look at the companies where the order book visibility is there. First company that comes to our radar is HBL Engineering. Right. So HBL is one of the player in the Kavach, right? And management has guided that there was 5 companies awarded for Kavach, right? Only 2 companies are qualified with the newer version of 4.0, with HBL having a lead of about 8 to 9 weeks, right? And other 3 at the time of their AGM was unqualified. So on the Kavach part, only HBL is the only company I think which is successfully started implementing Kavach orders, right? So what happens is like if the other companies are not able to execute their Kavach order, that orders will be re-tendered right? And HBL is fully prepared for any possibility that they have provided. Currently, their revenue is around 2,000 crore. They have an order book of around 4,500 crore. And basically, the company is saying they can easily have a covered sales should be around 1,300 to 1,500 crore every year for FY 27, 28. But later they should have, but for next 3 years, the company will be directly beneficial from the coverage implementation because they've been working since 2005. And coverage is not a very easy thing to do. Like we only see coverage, but there are a lot of moving parts in the coverage. There are more than, I think, 100 products that need to go into coverage system. Therefore, the other companies are not able to qualify. Then the management says, so their TMS system and the centralized train control part of the business should compensate post 2028. And the rail signaling is the single largest business to FY30. So it could be the proxy of railways if someone wants to bet on. Then the company is also into the electronic fuses. So if you go through the AGM notes that management has given, you will find the very interesting insights of how mechanical switches were used, fuses was used. Now the company is making the electronic fuses, and Bharat Electronics is also in this part. So, but in the on the AGM notes, management had sent something about Bharat Electronics also that they are basically importing a lot of products and assembling in India, but whereas HBL is trying to manufacture this in house, and so they think like this business could be the second largest business by 30. And company can with all the R&D expenditure that they are doing, the company can achieve somewhere around 4,500 crore of sales till 2030. So this will double in next 5 years. So around 25% CAGR growth can happen. The next company is again Bharat Electronics. So their current revenue is around 24,000 crore. Their order book is somewhere between 75,000 crore as of 1st of October. Right. And if you look at today, they have got new orders of like 15,000 crore in this year, in this financial year. And they said that in QRSM, like we have covered these things in detail in our defense webinar, but the company says like there is already a order book of AON signed of around 1.4 lakh crore, and company is confident of getting around 50,000 crore of order from that. So they already have 74,000 crore order book, expecting new 50,000 crores of order by end of this year, and current FY25 revenue is only 24,000 crores. So huge order book visibility is present for Bharat Electronics. Then the very interesting company in GRSC. Again, it's a proxy to shipbuilding. If we look, we have covered these things in detail in our webinar. And we are also focusing maybe in January to have a new webinar only on shipbuilding, right? Because we think that could be a very good theme to play out in future. So their FY25 revenue was somewhere around 5,000 crore. Current order book is of around 20,000 crore. So 4x of their thing. But again, we need to look, these orders are very long dated, right? They can take somewhere from 3 years to or maybe 10 years for certain vehicles to get materialized. So we should not get excited at the face value of order book. But again, this company is making basically special purpose vessels. So it's a smaller vessel which have a faster execution time from 3 years to 5 years. And they have also making 12 multi-purpose vessels for German clients. Right? They are also working with the government of West Bengal for hybrid ferries. Right? So this company has been making vessels for Indian Army, then export, and then state government also. Also, management thinks that they are confident of ending this year with 50,000 crore of order book, and this would be the highest ever order book that this company had actually had. Right. So that's the kind of options or the opportunities we have in the shipbuilding segment. Currently, the shipbuilding AON is the acceptance of necessity. So the military needs to raise AON with the Ministry of Defense. So currently, the Navy has raised around 1.5 lakh crore of orders with Ministry of Defense, and a lot more still to go. So again, this will beneficial maybe only 3 companies if we look at of the shipbuilders. GRSC maybe in the forefront. If aircraft carrier news comes through, then this could be the trigger for another company, another shipbuilder, which basically manufacture large vessels. The next company which came to on our radar is basically due to the capex that this company is doing. This is Mancasia coated metals. Right? If you look at it, what they basically do, like they take HRC, then they do cold roll steel. They basically galvanize it with zinc to make it rust proof, and then they basically paint it, and they call it pre-painted steel (PPGI). So their revenue uh, from both the steel part has been basically the company is mainly focusing on pre-painted steel coils now because they have a higher realization. Right, so the pre-painted realization is somewhere around 88,000 per ton, whereas galvanized it's only around 71 or 72,000 per ton. Right? So companies incrementally focusing on painting. Again, in the next part, we will see like what the capex plan that they have saw, but also their export share is also increasing. So if you see like in this part, around 80-85 of this percent of the revenues came from the export part. And that's how we got interested in this company. And their margins are also decently healthy. So they have an order book around 600 crores. In FY25, I think they have done somewhere between 700 crore. Right. And their execution timeline will be the next 12 months. So now let's look at the capex and the timelines that they have seen. So they will convert the entire galvanizing capacity from zinc to aluminium zinc. Right? So it will use 55% aluminium, 43% zinc, and 1.5% silicon. Right? And this will be happen within FY26. Why they are doing it? Because aluminium is much cheaper than zinc, and aluminium zinc sells at a premium to galvanized steel. Right? So their cost will reduce because aluminium cheaper than zinc, but their realization can go higher because aluminium zinc coated sells higher than a galvanized steel. So that's the first thing that they are doing. In the second phase, they are expanding their, and in the first phase, they are also increasing their capacity by 36% of galvanized steel. In phase 2, they are adding a new color coating line, captive solar, plus other project, which will be completed by early or the first half of FY27. So in the capex, they are increasing their painted capacity by 174%, which is again a very huge. And they have also captive solar, which will reduce their energy cost by 50-55% on from the grid. So if you see, like massive capex plan has already been rolled out. Their company has raised money for this capex, and this company I think should be on the radar and track closely on the execution part because margin expansion story can play out here, and revenue growth can also be the trigger for this company. So both the triggers will be there in this company. And if margin get expanded and volume growth comes in, I think multiples re-rating would also happen. So that's how this company came on our radar. The next thing or the next way of which we look at the companies at Alphawealth is key acquisition that happened. So one key acquisition that happened in this industry of this IMFA acquired a Tata Steel's ferrochrome plant. Right, so they have paid somewhere around 600 crores, right, and they have acquired the total capacity of this plant from Tata Steel, right, and they will be incurring some other costs other than the acquisition cost. So entire cost of the acquisition will be somewhere around 750 crore. The company is saying the real advantage will come in from FY27, and proximity to the chrome mine nodes and the upcoming greenfield expansion project that they are doing. This could lead to significant cost savings and operational synergies. And IMFA will be the largest producer of ferrochrome in India and sixth largest globally. Right? So these kind of acquisitions we need to track closely because in metals and mining, basically the lowest producer of any commodity wins the game. So an IMFA, again, it could be a very interesting play. We have not done any valuation exercise for this, nor done the projection. It's just the acquisition that came into our radar. Again, if you are interested, you should do the deep dive on this business. Or in the later sessions of Stocks Pe Charcha, we can cover this company at a detailed level also. One interesting company that we have been reading for some time is RateGain, right? And they are basically into the travel technology platform provider, right? One of the best management that we have seen in the platform business, right? And this company acquired a company named Sojourn, right, and its subsidiary. They have acquired this company at around 2,000 crore valuation in the mix of internal cash and debt. Right. What Sojan basically does is it's a AI-led marketing company in travel and hospitality. Again, RateGain base business is also in the similar category. They are serving around 13,000 crore, 13,000 customers. Right. With this acquisition, RateGain builds the world's most comprehensive AI-first travel technology platform. Right. So, which helps them to acquire, retain, and engage guests. मर्जर अभी जो रेडगेन का इससे मर्जर हुआ उसके भी मार्केटिंग टेक के साथ जो इनकी एग्जिस्टिंग प्रोडक्ट्स है वो आ जाएंगे, राइट. एंड सोजन की जो डिमांड जनरेशन एंड ट्रैवल एंगेजमेंट एक्सपर्टीज थी दोनों मर्ज होके एक सिक्युलर प्लेटफॉर्म दे पाएगी रेडगेन. सो वेरी इंटरेस्टिंग प्ले. सो रेडगेन ने बेसिकली अपनी तरफ से अराउंड 1,000 करोड़ खुद की तरफ से दिए एंड 1,100 करोड़ का लोन लिया at the interest rate of 6.5%. Again, it's a very decent cost, very nominal cost. And this acquisition has placed RateGain ahead of its medium-term plan to reach 2,000 crore by FY27. Right. So with this acquisition, जो इन्होंने 2,000 करोड़ का guidance दिया था, now they can already achieve 2,700 crore in FY26 itself. Right. That could is around 50 to 60% consolidated revenue. Full year margin will also increase because of this acquisition, and then now their consolidated EBITDA margin and it should be 17 to 18%. So overall, again, it's a very pertaining acquisition that they have done. Now they have a capability. I think we should read this company independently, or in the next session of Stocks of Charcha, we can cover RateGain and the few other companies which we think are very interesting in detail. The next acquisition again in the alcohol segment has been of by Tilaknagar Industries, where they have acquired Imperial Blue. अगर हम देखेंगे कि why this acquisition makes sense for Tilaknagar is basically they used to be a South dominated player and a brandy player. But with this acquisition, they will get the pan India network of Imperial Blue. Plus, they will get a whiskey portfolio. Now, they have a presence in the entire again predominantly in the south, but still they will get diversified Tilaknagar Industries, and they will get a better product mix. So the total revenue will be somewhere around 4,500 crore. And they have done in a basis of 4,000 crore का slum sale transfer हुआ दोनों में, and this has been funded by 50-50 of equity and debt. And the CCI approval आ गया है 7 अक्टूबर को मेनली, एंड दिस एक्विजिशन इज नाउ कंप्लीट. सो अभी तो हम इंक्रीमेंटली देखेंगे मे बी 1 या 2 क्वार्टर शायद हमको थोड़ा ये ऑपरेशनली चैलेंजेस दिखे, क्योंकि जो भी कंपनी एक्वायर होती है नन ऑफ देम गेट basically aligned everything together in single or 2 quarter, but on a long term consequences it's very good acquisitions by Tilaknagar Industries because उनको एक नया प्रोडक्ट मिक्स भी मिल गया प्लस एक नया मार्केट मिल गया है एंड इट विल बिकम अ पैन इंडिया प्लेयर. जो हमने अभी एसोसिएटेड अल्कोहल केस में ट्राई किया वो ऑर्गेनिकली ट्राई कर रहे हैं, which is a much longer process than what Tilaknagar has gone through the in acquisition route. So that's one. Then we will move to the next segment. Before that, we will just do a temperature check. Are you guys liking the session? Maybe you can just react it so that we understand it. Perfect. Let's move to the, again, this is the segment which is a food for thought kind of a segment for you, right? And we have also been thinking on these lines for long. Right? The agenda for this session is to like present different type of companies, how we can do the idea generation, right? So we have gone through sectoral tailwinds and huge order book growth. Then we have seen companies जहाँ पे good acquisitions हो रहे हैं, right? But there are certain companies we need to see even after a fantastic results, we will not see revenue, stock price growth, and we will come to the things later. So we always see tax cuts, both GST tax cuts and the income tax rate cuts as a welcoming steps, right? But we have seen market is not responding to them. So like what could be the reason, right? Like, because this thing has been the pertinent point which middle class has been asking this for long now. But government, so like if we look at the holistic approach, right? If we have a cake, like government only has a fixed revenue that they can spend, right? and government cannot print their money at their will, right? So they need some revenue generation also, and after that they can only do the revenue expenditure, right? Which is the government capex we call it, and revenue for government, the revenue that they earn is the from the tax collections primarily. So with both GST and the income tax cuts, right, what we will see is the delay or basically the government capex will start slowing down, right? And this could be the good food of thought because we think consumption should boost in. And why government has done these cuts is because government has realized the underlying consumption economy is not growing in India, right? If you look at the car sales data or two-wheeler sales data, it has not grown much in last 4 or 5 years. There has been a pent-up demand from the COVID, but more or less domestic consumption was not going anywhere. Therefore, they have done the tax cuts. But now they have done the tax cuts, their revenue will be lower. So they need to reduce their expenditure at some places. Again, freebie culture is again going on in India, right? So that cannot be stopped because how will they will come into the power? Nothing against any government, but it's just the as an investor we need to look all the data points. So where the tax cuts impact will happen, it mainly on the capital expenditure that government is doing, right? And in this graph, again, this has been taken from Novama research. So the government capex percentage, if you look at it, right, in FY 21-22 was somewhere around 12 to 15%. That has led to the massive order book growth that we have seen in FY 23, 24, 25, right, for most of the companies, and that has been implemented. But what incrementally happening is now in H1 26, the growth rate has become -2 of government capital expenditure. That's how, if you look at it, right, money is moving out of the EPC companies. Because अगर government expenditure नहीं होगा, तो future जो growth होगी in power or maybe highways or all the other things, वो incrementally speed slow down हो सकती है. And जो valuations हमने EPC companies में देखी थी, वो 20 to 23 के period की level की थी, because वहाँ पे lot of order book has been coming and ahead of the earnings में market ने companies को re-rate कर दिया था. So now let's look at the few companies. One is Wandada Engineering. So इसमें देखेंगे ये कंपनी सब जगह पे है, right? Recently they have also announced defense, और defense के अंदर भी कुछ EPC I think they have done, right? So they have a strong order pipeline around 3.8x of their FY 25 revenue, right? Their H1 26 revenue has increased 153%, and they have submitted tender of somewhere around 7,000 crore, and they are already L1 of 2,000 crore of order, right? But what we see in the next slide, yeah. But what we see even after the fantastic result that is coming, if you look at the median PE of this company has been derated from around maybe 160 is unsustainable because this has been a huge rally, and this has been made in terms of a very fantastic result that should come maybe 1 year down the line. That's precisely happening. 100% growth is coming in EPS, but the stock price has been derating continuously at around 20-25 level. Right? So now what, as an investor, what should we think, right? Should it move to the median P of 65, right? What's your expectation could be here? If we can have some output from your side. Do you think whether this company will keep on, like this company will get again re-rated to around 30, maybe 60, 65 per multiple? आप लोगों को क्या लगता है? Maybe in comments you can answer. Yeah, a lot of people are saying thumbs down, right? क्यों नहीं होगा? क्योंकि जब भी हमने देखा ना, लाइक गवर्नमेंट का इंक्रीमेंटल अगर केपेक्स नहीं आएगा यहाँ पे, तो ये ऑर्डर देगा कौन इनको, राइट? द बिग साइज ऑर्डर्स. So that could be the thing. Again, इसका sustainable PE क्या हो सकता है? What we think could be somewhere between 15 to 30 range. And अगर next order वो growth अगर strong नहीं रहेगी, तो ये जो 150% की profit growth है, क्या ये भी sustainable है? Answer may be no, right? And collections need to be seen. अभी collections होगा कि नहीं? So that's how this business has been got derated. But as an investor, our expectation of this business trading at around 60 or 40 multiple, right? That's the wrong expectation that we are taking. If this happens, that could be the case, but we cannot have these things in our thesis while buying the company. Similar example is for Oriana. Again, I think it's a better company, but so they have also grown their revenue from operation by 120% in H1 26. They are also moving into the ESS segment, right? But again, they are also working on green hydrogen and derivative. They have acquired some land, so they are focusing as a true renewable energy company. But इसका भी अगर हम वो देखेंगे, जो डीरेटिंग हुआ है from 100% P 100x PE से around trading currently at maybe 20 to 23 of P, and company is growing at 100%. So the same thing is happening for Oriana Power also. Also, let's look at Danish Power. So Danish Power के पास भी similar case हो रहा है, right? They are making transformer space, and even in the transformer we think जो historical multiples है शायद वहाँ पे मूव ना करे, क्योंकि lot of companies, lot of supply is now coming in inverter duty transformer जो आज से पहले नहीं था. So ये सब चीज इंटरकनेक्टेड है. अगर सोलर केपेक्स नहीं होगा तो सोलर ईपीसी कंपनीज को नया पैसा नहीं मिलेगा, ऑर्डर बुक्स कम होगी. अगर सोलर केपेक्स कम होगा देन जो इन्वर्टर ड्यूटी ट्रांसफार्मर उसकी डिमांड भी कम होगी. There is already a lot of capacity which has been built in IDT transformer, like Terrell has come up with the capacity, Danish has capacity, then Silchar has, then a lot of other players have also IDT capacity which is coming live in FY27. तो अगर डिमांड कम होती है थोड़ी भी, maybe 5-10% भी, and supply increases by 40-50%, what do you think happened to the realization? The margins will start decreasing, not in next 1 or 2 quarters, but in a long term basis, in a medium term basis, 3 to 5 years. And market assess these things at a this again market is a forward discounting machine, we call it. So market always look at what could happen in next 3 to 5 years. तो अगर आप ये सारे डॉट्स को कनेक्ट करोगे, यू विल अंडरस्टैंड जो हिस्टोरिकल मल्टीपल्स थे ऑफ अराउंड 30-35 मल्टीपल, वो शायद सस्टेनेबल ही नहीं है, राइट? आवर एक्सपेक्टेशन शुड बी अराउंड 20-25% पीई मल्टीपल. अगर वो हमको वहां पे सस्टेनेबल ग्रोथ लगती है तब जाके इतना मल्टीपल सस्टेन होगा. सो दैट्स द फूड फॉर थॉट. So we need to always look at the future growth that can happen in the industry at what the current multiple you are paying. So जब हमने अपार इंडस्ट्रीज 2021 में लिया था, वो कंपनी टोटल 2000 करोड़ की थी, एंड उसका पी वाज समवेयर इन 11-12, राइट? एंड उसके बाद वहाँ पे ग्रोथ ट्रिगर्स थे, एबिटा मार्जिन इंक्रीज के ट्रिगर्स थे, एंड दैट कंपनी वेंट टू अराउंड 40-45 टाइम्स पी, राइट? सो दैट्स हाउ वी गॉट 10 bagger in अपार इंडस्ट्रीज. So the next and the last segment for today is mainly the few companies which are growing at a very high pace and looks decent. Again, we need to check what's the sustainable growth rate for this company. One is V2 Retail, growing at around 50% revenue growth. Same store sales growth is around 8 to 10%, 20% ROE. Their margin was, gross margin is targeted to around 28 to 29%. Right? They have opened 43 stores in Q2. Right? So this is the company which is doing the good work that we think in the retail. I mean, retail is a very difficult segment to break in. To run a profitable franchise in retail is very difficult, and to maintain growth, we have already seen the example of Trend. It's very difficult. So we need to be very cautious on what multiples we are paying in and how much future growth is already baked in the valuations. The next interesting company is Pearl Global. Again, we have been tracking this company for maybe now a year. Very good management, right? Even after the Trump tariff, this company has operations in maybe Philippines, Vietnam, right? Indonesia, Bangladesh, right? And they have also Gumtala facility है इनके पास, जो US के पास में ही है. So the Pearl Global has a diversified business. That's why गोपाल दास पे ज्यादा हिट हुआ है, Pearl Global पे उतना रेवेन्यू हिट नहीं हुआ है. क्यों? क्योंकि Pearl Global का डाइवर्सिफाइड बिजनेस है. So that can be the पॉजिटिव एंड नेगेटिव. अगर मान लो इंडिया की ट्रेड डील बहुत अच्छी होती है एज कम्पेयर टू द पीयर्स, तो मे बी गोपाल दास को ज्यादा फायदा हो सकता है. बट पर्ल ग्लोबल इज अ मोर बैलेंस्ड बिजनेस इफ वी लुक एट. लोगों को इसके बांग्लादेश के सेगमेंट के ऊपर काफी इशू था कि बांग्लादेश में अनरेस्ट हो रहा है, बट अभी तक जितने भी रिजल्ट्स हैं, बांग्लादेश इज परफॉर्मिंग वेल, एंड टेक्सटाइल इंडस्ट्री बांग्लादेश के लिए बैकबोन है. सो आई थिंक दैट विल नॉट हैपन, लाइक द व्हाटएवर हैपेंस, वो बहुत डिफिकल्ट है उसको डिसरप्ट करना, राइट? एंड इवन जो मे बी वहाँ की जो पॉलिटिकल पार्टी के राइवल्स, वहाँ पे सबके बाद एक टेक्सटाइल मिल्स होती है. सो जो शेख हसीना की पार्टी थी उसकी टेक्सटाइल मिल्स काफी बंद हुई है. So that also led to the consolidation in Bangladesh, and Pearl Global ने clearly सब communicate किया अपनी Concalls में. So one of the best management, if you want to look and or track the textile space, again they are the garment manufacturer, and in the textile value chain, we think garment manufacturer is the only player where we as an investor can make money, right? So that's very interesting. You can go through this company. Again, the growth rate will be somewhere around 15-16%, and EBITDA margin will be there. So it's a low growth, but it could be a sticky business. The last company that we have is, second last company is Privy Specialty. very good company because management has reiterated their long-term growth guidance of 20%. So what we check is for growth where sales growth is there, and there should be a sales growth of at least 2 years or 3 years. Visibility should be there. That's only when the market start re-rating the company. Again, I'm not saying this company is cheap or re-rating will happen, but it's a very decent company. EBITDA margin will be between 24 to 26%. They have proposed to amalgamate other subsidiaries into the parent company. That's the key trigger. And they have a guidance of 5,000 crore revenue and 1,000 crore EBITDA in next 5 years. They have done the capacity expansion in by January, December 25 and Q4 से ये start हो जाएगा. And company is one of the very diverse, backward integrated player. अगर आपने प्रीव्यू देखा होगा, it's basically in the aroma chemical. So वहाँ पे backward integrated है. तो उनको क्या होता है, सप्लाई चेन के ऊपर काफी ज्यादा कंट्रोल आ जाता है इन केस ऑफ एनी टर्बुलेंस दैट हैपेंस. सो देयरफॉर इनके मार्जिन काफी स्टिकी रह सकते हैं. द लास्ट कंपनी which came on which is on our radar for long and we just wanted to share with you is Deepak Fertilizers. तो एक कंपनी क्या हो रहा है, एक मैसिव केपेक्स कर रही है of maybe around 4,500 crore. This capex has been already like 87% done and 70% done in nitric acid and 10. ये technical ammonium nitrate है. तो ये जब 5,000 करोड़ की केपेक्स करिए, इसका एसेट टर्न अगर 2 भी हुआ तो यू गेट 10,000 करोड़ ऑफ न्यू रेवेन्यू शुड कम. एंड ये केपेक्स लाइव हो रहा है FY27 में. तो नाउ वी आर नॉट वेरी फार अवे फ्रॉम दिस केपेक्स जो लाइव होने वाला है. ठीक है, तो मे बी 1-2 क्वार्टर में थोड़ा पीएनएल पे डेप्रिसिएशन हिट वगैरह आएगा, बट आई थिंक ये कंपनी को काफी बड़ा, दिस विल बी द थर्ड लार्जेस्ट प्योर प्ले टेन प्रोड्यूसर ग्लोबली. एंड एज वी हैव सीन, जहाँ पे भी कमोडिटीज की बात आती है, lowest cost producer is mostly wins the race. तो ये बहुत इंटरेस्टिंग प्ले है. तो similar thing. So that's how we ended our session. The next thing that we want to basically say quickly is we have been doing sectoral webinars for long. So basically we have done 4 sectoral webinars. A lot of people have reached out to us to create an annual package of that. So we have also clubbed some other services, right, that we are planning to start. So we want to launch Alphawealth Investing Club. So what we will offer is mainly the sectoral webinars. Like it will be included in this segment. All the sectoral webinar that we will do, this will come under this segment. And again, you can also avail individually, but yeah. And then the exclusive Stocks Pe Charcha, mostly we will be including in this. Then what we are trying to do is like we want to invite guest webinars. So it will be basically renowned market experts, analysts or industry से कुछ अच्छे लोगों को लेके, where we can learn more about industry, learn about different investing philosophies that we have. Right. So guest webinars we will try to focus more. Fourth one is like we meet a lot of promoters, like 2 or 3 promoters on a monthly basis. Right. So what we can do, wherever possible, we can, if you are in that city, you can come up with us for factory visits. If not, we can include you on the call. At least if we are going for a meeting, we will ask in the community if you have any questions, and we can ask those questions on your basis and get back to you. Third one is again exclusive investing club where you can share your ideas, right, where we can discuss more opportunities, right, and we can also have a physical meets as and when possible. And we will try to do at least once a quarter or maybe once in H1 for next year. And then what we are working on is not a elaborative course, but a small 2-hour workshop where we will say how we do the idea generation, right? Our buy and sell strategy, which we think is working for last 7-8 years and showing good results. So how we do the sell decisions, how we do the buy decisions. So all of these offerings will be into one umbrella, and we launch it Alphawealth Investing Club. So core team is again Kaustav and Manthan, and we have other few people which is behind the scenes. And the price that we are trying to launch is again it's around 1K per month, but for December 2025, if you are interested, it will be around 8,000 per year, right? And for next 1 week, like what we are planning is to launch it for 7,000 per year. So if you go through it, you can avail, like we will share the link with all the participants registered here. If you are interested, you can avail it around 7,000 rupees per year, right? And all the sectoral webinars, past webinars, and the future 1-year webinar will be incorporated into this membership, right? And we have tied up with Learnness, so all the data and the content will be uploaded there. You can watch it as per your convenience, and all the Stocks Per Charcha webinars or content will also be uploaded there. With that, again, I should move it to few participants that wanted to share their idea. So just give me a minute.
So Manthan, Venkatesh has asked how to subscribe.
Yes, I will. We will share the email with you, right? Or maybe we can send in the comments. Prince bhai, if you have the link, if you are here, you can send it, please. If not, I can share it with you. Just give me a minute. Till the time, I think.
Yes, I think
Rushil,
look forward to our investing stars to share ideas and make it a collective wisdom learning community. That's the idea. So who had volunteered? Can you just
so
either put it in message?
is Rushil ji present here?
Yes, I am present.
Yeah, Rushil ji, you can go ahead. Again, you have, I think, so Rushil ji will be talking about the stock name Sharda Crop Chem. Right? It's from agrochemical industry. Over to you, Rushil ji.
Okay, thank you everyone for giving me the opportunity, and good afternoon everyone. So my idea is on Shada Crop Chem. So basically, I just give a gist what Shada Crop Chem does. So Shada Crop Chem is a 7,200 crore market cap, and it's a global player in the generic crop protection industry. So they act as an intellectual property expert and global distributor. So basically, if I can just explain you with their business model in a simple way. So what they do is that, they secure the legal rights to sell the products in the world's lucrative and regulated market, which are high margin market, we can say Europe and NAFTA. So what they do is that, they target a generic chemicals which are going off patent in the highly developed markets, and which offers the best margin also. So what they do is that they invest heavily in creative dossiers. Dossiers are basically the physical documents, which contains technical data and test results, and they obtain the registration. So which act as a barrier also, as this process is very complicated, capital intensive, and time consuming. Sometimes we can say 5 to 7 years also it may take. So this act as an entry barrier for the competitors. So what they does is that, how they do the pricing strategy, since it's a generic. So they generally sell below the innovator product price, typically 10%, to maintain the margin. And also, if let's say the product is low margin, so they focus more on the margin rather than on the market share. But generally they sell the products which are high margin, so basically they sell it below innovators prices. So what they do is that once they get the license in those geographies, they don't manufacture by themselves, they do it through outsourcing. Basically 90% is from China, and to that they distribute the products under their own registered brand name to Europe, NAFTA, Latin America, and everything. So what are the, like, why this company is currently attractive? So what is happening is that if you see that they have a already registration base of 2,980 products, and there is a pipeline of more than 1,000 in an application, which shows that there is a future revenue visibility. Also, the if we see the balance sheet, it's a net debt free position, and they hold a cash of around 790 crores. So, and also what happens that since it's a global distributor player, and it's a fragmented market also, and they have just 4 to 5% market share. So if let's say they gain a 1% also market share, we can say that this company can grow to 15 to 20% easily. Plus, what is happening currently, if you see that now the after the extreme volatility and price which crash happened in March 24, you can see it from the result also. So the completion of high inventory cost and high inventory cost liquidation has done, and now we are expecting the stabilization, improvement of generic prices, which are increasing but slowly. So which we think that the headwinds have been the past, and now there is a pickup in the growth, and also the prices have been increasing but steadily. So that is what we have been seeing in this. And now just the key risk And also, they have been focusing highly on the lucrative markets, as I mentioned, that in Europe and NAFTA. So, which are the highest margin as they are regulated. So, Europe is the highest for them in terms of gross margin, if we see. Now, what they have another business which is a small contribution, which is non agrochemical business, which we say they make a conveyor belt and dyes and dye intermediaries, which are so conveyor belts are basically custom made, so they don't stock and sell. It's a custom base. So basically, it's again a high margin business, and it contributes around 18 to 20%. And also, this company focuses more on herbicides and insecticides, which is being growing, and fungicide is being contributing little less. So herbicides is the highest contributor, and also it is the highest growing in the market also. So now, if we see the key risk, according to me, the key risk is first if we see the volatility in the currency. So what this company does, they buy in USD and sell it in euros. So if weak euro against the USD can actually directly impact their gross margin also. If we see, second is um, their dependency on China. As I said, that 90% has been outsourced from the China through manufacture. So if let's say their government changes any policy, like let's say tomorrow pollution control measure comes, or the factory is being shut down because of climatic conditions or geopolitical tension, that can have a supply chain disruption for the company. Also, what is there, generally what happens, the key thing to also to see in this company is that we have to see the innovator, how the global inventory is being there in the market. If we see, so what happens that generally if we see that liquidation is high, let's say sorry, inventory is high, and even the global innovators are facing challenges to sell the product. And so what happens that they reduce the price. Even Sharda players like generic has to reduce the price, so which results in inventory loss, you can say, loss in margin also, since they have to sell at lower price. So that stock revaluation can happen, which can impact the gross margin. And the most important is the regulatory risk. Let's say if they are selling, let's say in Europe, and suddenly the government bans that crop, bans that product, or a molecule, we can say, due to environmental concerns, or let's say anything. So that can, the company may have to take a write off for that. And also if let's say also the product is being banned due to any other reason, and it's a high working capital intensive business, and it's a seasonal, so we have to see the cash flow, and this company has been managing cash flow over the years. And also another important, which is not in the control of the management, is the weather. So it's a seasonal business, and it's so weather condition should be better in the Europe and NAFTA, where they are selling the product. So let's say if any one quarter, which H2 is generally the high season for the company, and let's say there is a drought in the market in the Europe, so again the cycle goes to next 6 to 8 months for the growth. So that can be the risk. But currently, if we see the last 2 quarters, company has been doing really great, and they have been guided for the revenue growth. Recently, they upgraded their guidance from the Concall also. From Concall, recently they came in CNBC. They said that they will be easily to achieve 20% annual growth. Margin is also sustainable around 18% for this year. And what gives us confidence for the future growth, the capex they are doing 400 to 450 crore, which is intangible, we can say, because they have a registration of 1,000 products pipeline. So which gives us, comfortable for the future growth. And also the prices have been stable, and there is in general upward in the prices, though it is going slowly, but and always the second half is always better than the first half. So yeah, and I think there are some key things to track in this business. Is ones I mentioned is gross margin, registration pipeline, then geographic sales where they are selling. So I think, and the product mix, are they selling high margin or low margin products? And I think Sharda is currently more value added products than compared to the commodity or old products. And one good thing is that they don't manufacture themselves. So if any low product margin business, they want to get out of it, or any product is being banned and they want to sell other products, so that can be easy for them to do. So I think so just to summarize, it's a like global library service for modern agriculture science, and it has a right which is very entry for very to do registration and to create a dossier. So also, if we see the valuation, the 10 years, if you see the PE ratio also of the company has been ranging around 16 to 80%, 18 multiple, and EBITDA is also 8 times somewhere around. And currently the company is trading there, and the growth guidance for the next 6 months is looking good, and also for the next 1-2 years as the registration pipeline is strong. So this is the gist about the company and the why we like, what are the risks, and things we need to track. That's it.
Yeah, thanks, Sushilji. Quite an elaborative uh, understanding of the business, right? So there are a few companies also in this segment, right? Punjab Chemicals and so
I think there is no one like compared to Sharda. If we can just see real compare is UPL, because UPL also does a distribution, but they are more into a Latin America,
mm,
whereas we see Sharda is more into Europe, which is highest contributing segment and high margin, and second is Northern America, where even UPL is also present. Whereas Dhanuka is more into an Indian player, like they have their own manufacturing and they focus only in India. So I think what for Sharda, I think we have to see generally the global innovators, like how they are doing, uh, whether the demand trend for them is strong or not. So that way, even Sharda will do well. Because if inventory stocks happens from the innovator side, then the Sharda will also have to take a hit due to, let's say, less demand or oversupply from the China, or let's say the drought season. That is why. So I think inventory is a key metric to track, and that is why the company we say that it's a working capital intensive. So inventory and receivables are very
mm,
important to track.
right, right, right. Yeah,
Okay, who's next?
Thank you.
thank you so
Thank
much,
you,
Sushil.
Rishilji.
Thank you,
It
sir.
was really a pleasure to listen to you, and would like to have you in the club. As simple as that.
Thank you. Thank you. Sure, sir.
Then Samarji, if you can,
Yeah. So hi
your company is
everyone.
Ajax, right? Yeah,
Yeah. Am I audible?
yeah, you are audible. Yeah,
Okay. Okay. Thanks. First of all, thanks for the opportunity and thanks for all your knowledge sharing. Really helpful. Yeah. So I will cover Ajax Engineering in 5 minutes, and the structure is basically similar to the earlier participant briefing of the company thesis, antithesis, and bit of evaluation from a valuation point of view. So
right.
Ajax Engineering is a concrete equipment manufacturer, and it has basically two divisions. They categorize it. One is SLCM and another is non-SLCM. So SLCM stands for self-loading concrete mixers, and the good thing is Ajax has 75% market share, and it is a market leader in this category in the SLCM space. So the overall key products for Ajax are SLCM, then batching plants, transit mixers, self-propelled boom pumps. Then they are getting into high margin products like pavers, and new optionality which is coming up is related to 3D printers which they have introduced. So currently market leader in SLCM, and they are gaining traction in the non-SLCM space. The other things which we talked about. So they have a strong dealership network of 51 dealers in India, the biggest network in the concreting space and concrete manufacturing space, and in present in 23 states, and they have 25 international dealers, and their equipments have been exported to more than 45 countries as per their communications. Then they have a diversified customer base. They work with individual contractors, then small and mid-sized contracting companies, then large construction players, as well as the rental companies. There are rental companies who buy their equipments and they rent it further. So the basic principle is the currently the manual concrete mixing has like till last year, if we see the last year data, it has 75% market share, while the equipment manufacturing or automation of manufacturing, it has a smaller market share. So the SLCM has overall 14% market share, and the overall mechanization of concreting, that share is quite less in India if we compare with various other countries, and there has been reports that this share is expected to grow up in the next 4 5 years. So if we consider the industry time, if we look at the FY24 figures, the overall concrete machinery industry was like it had a time of 6,100 crore, out of which SLCM was 2,100 crore, batching plants 1,500 crore, transit mixer 1,100 crore, and rest belongs to other equipments. And this time is expected to grow at a healthy space. So the expectation is by FY30 this can reach to around 18,000 crores. So there is an expectation it can at least close to triple by FY30. That is one of the thesis behind this company. And overall thesis, this like it is play on the increased mechanization of concrete consumption in India. So it is very less as compared to various developed countries or even other developing countries. And concrete consumption is also similarly expected to increase in India in the coming years. So SLCM, we talked about the 75% plus market share. So one thing to analyze was, is it a big fish in a small pond? But if you look at the overall structure, the overall sector itself is expected to grow in a good manner in the next coming like few years or multiple years. So it may be a big fish in a bigger pond or a river, and it can grow well with this, or it can be the first company to take opportunity of this if the overall sector like grows in a healthy manner. That's how I'm looking into it. Then it is a proxy to infrastructure spending. That is one of the important thing. Their main the SLCM part which is there. So it main majority of the SLCM machines are used where there are infrastructure spends related to roadways, railways, then ports, waterways, irrigation. They are present across all these areas. Urban growth like smart city and all. There also their machines are present, and okay, also related to skyscraper buildings where there is a more and more requirement of concrete. Then it is a proxy to renewable energy construction, because all these solar plants, then windmills, they are requiring more and more concrete, and they are using these kind of machines to build the plants in a faster manner. Similarly, airports as well, where these machines are used. Then one more important thing is the Ajax, how it stands apart from its competitors is it has high resale value. And one thing which I liked, when I went through all the details, is it has a very strong R&D focus, and it has been a first innovator in many of the products. Like it is the first Indian company to export pavers. So pavers across the world, and it is a very complicated product, and it is a very high cost also as well as high margin product, but it has successfully delivered these pavers. So that's why there has been some cyclicity in the revenue, because when such pavers are sold at that time, the revenue inflated and margins will also go up. But in future they want to get into more and more in this category, so we need to monitor that. Also the first company to introduce 3D printing or 3D printed construction. There have been a few constructions happening in this manner already in India. It is demonstrated, and if it works well, then it can reduce the construction cost at least of small structures, smaller structures. And we can go through those details. There are videos around this, so which is a good optionality to check with how it is adopted in the coming time. It is also again an automation, and with which reduces a lot of errors in these constructions. So overall, this they have Ajax School of Innovation to specifically concentrated on the concrete manufacturing, and so something unique. They have patent in these pumps which they have introduced, self-propelled concrete pumps. So something unique about the business, and they want to now also expand in the non-SLPM sales, which we need to monitor how it goes well. And overall management, if I look at the con calls, there are only 4 con calls for this company which are done till now, but the management looks like they are not in the talks or in the tone of just trying to make investors or question the people who are asking questions happy. They are giving a clear guidance. Even though they have higher sales growth per numbers in the recent years, they are sticking to certain numbers, and they are not. They are looks to be under promising and delivering more. That I can understand from them, and they have a very clear acquisition strategy and all present with them. So overall, it looks good. The antithesis for this one point, I think, Manthan, which you highlighted, if there is an infrastructure slowdown, it will definitely have impact on the capital goods related companies. So we need to keep, but their overall 60 to 70% of sales is related to infrastructure spend, but it is not like they are directly dealing with government agencies. It is an indirect play. Infrastructure projects given by government, so the contractors and all get buy these equipment, but not directly any contracts with government. Rest of the, but like it is spread over so many different sectors, so maybe one sector here and there should not slow them that much. That let's see how it goes. It has a long dated life cycle product. It has 7 to 8 years useful life, most of the products, or even more. So but overall the industry is growing, so the bet is on that. Maybe once it matures, then that is a different story. SLCM is a major revenue contributor, 80% as of FY25, and we need to see how they diversify going ahead. There have been recently emission norms transition, like from emission 4 to emission 5, so which has increased their cost a bit, and they have immediately not passed it on completely. They are speaking about passing the cost in coming time. So let's see that so how it goes. But previous emission norms, there is a history that they have handled it well, and they have grown well over that period as well. It has cyclicity, the rains and all impact cement producers or concrete and all those stuff. So that has, so there is a cyclicity in the business. One needs to keep like note of that. And there, another risk is their manufacturing locations are concentrated in South India, like in Bangalore or around Bangalore area. So it is a there are different locations around Bangalore, but all the locations are present in the Bangalore side. And final thing is, it is recently IPO. So it was listed, I think, at the start of this year, and the complete IPO was OFS. But still, if we see, there is 80% stake with promoters. So that IPO was basically exit for private equity, which is okay from at least what I understand. So even still 80%, so great stake by the promoter itself. It has to come down to 75. So some, how they do it, that is something we need to see. So that is the overall antithesis. But overall, it looks promising with good R&D and good management capabilities. That is the overall reading. And valuation wise, if you see, then it is like close under 30, and the P ratio and market cap to sales and price to book also not definitely not cheap, not very expensive, you can say. Overall, if the growth continues in a decent manner, management guides for 18 to 20% annual growth, and with slightly expanded margins, with other pictures coming in, with other optionalities coming into play, it can be a decent bet. I look it from at least 3 to 5 years perspective. That is my thinking about it. Yeah.
Right. Yeah, like, we have also gone through. Thank you so much, Samarji,
Yeah.
of this Ajax again. Yeah, your point are pertinent. The only risk that we see, like you mentioned, is the capital expenditure that is happening, right? If it slows down, the growth rate can slump to maybe slight double digits, so 11-12%.
Mm-hmm.
वो एक थोड़ा risk है. But yeah, so again, like how we think of these businesses are, whenever in the correction you find it below 20 times PE. I think that could be the, well, again, it need to be accumulated over a period of time if we are not in the very good upcoming capex cycle.
Definitely, yeah, I agree.
Right. Thank you so much, Amarjeet. And the next one is Amrendra.
Thank you.
Yeah.
Thank you. Good afternoon everyone. मैं कैलटेक एनर्जीज डिस्कस कर रहा हूँ. ये एक इंडिया की लीडिंग एक्सप्लोसिव मैन्युफैक्चरर्स है और ये काफ़ी रेप्यूटेड ग्रुप है. ये मार्केट कैप इसका 417 करोड़ है. वैल्यूएशन रीजनेबल्स हैं. ROE ROC भी आर गुड. इसके दो मेन बिजनेस वर्टिकल्स हैं, इंडस्ट्रियल एक्सप्लोसिव्स और अलाइड बेस्ड प्रोडक्ट्स. इंडस्ट्रियल एक्सप्लोसिव करीब 84% ऑफ रेवेन्यू कंट्रीब्यूट करता है और अलाइड बेस्ड प्रोडक्ट्स जो है वो 11%. और इसको इंडिया के माइनिंग, इंफ्रा और कंस्ट्रक्शन सेक्टर का प्रॉक्सी भी माना जा सकता है. और इसके परलाइट बेस्ड प्रोडक्ट्स जो इसको इंटरेस्टिंग थोड़ा बनाते हैं. परलाइट बेस्ड प्रोडक्ट्स का यूज हॉर्टिकल्चर में क्रायोजेनिक इंसुलेशन प्रोडक्ट्स और फार्मा में यूज हो रहा है. क्रायोजेनिक इंसुलेशन प्रोडक्ट्स ये LNG, ब्यूटेन और इस तरह से हाईली इन्फ्लेमेबल गुड्स को ट्रांसपोर्टेशन और हैंडलिंग के लिए यूज किया जाता है. और मैनेजमेंट अब कुछ नया प्रोडक्ट्स की ओर, सेगमेंट्स की ओर ये डाइवर्सिफाई कर रहा है, जिसमें कि एक्सप्लोसिव्स के एसेसरीज, फ्यूज, डेटोनेटर्स और सम हाई प्रोडक्ट एक्सप्लोसिव जैसे PENT, ये सब के लिए डाइवर्सिफाई कर रहा है. और इंटरनल एक्रूअल से ही करीब 35 करोड़ का कैपेक्स कर रहा है. और इस कंपनी रेप्यूटेड ग्रुप से को बिलोंग करती है और पिछले 10 साल में कोई भी कंपनी ने इक्विटी डायल्यूशन नहीं हुआ है और नंबर ऑफ शेयर होल्डर्स भी 6000 करीब हैं. तो ये कंपनी के लिए ग्रोथ ट्रिगर्स हो सकता है, माइनिंग सेक्टर में ग्रोथ और क्रायोजेनिक इंसुलेशन प्रोडक्ट्स जो है ये कंपनी के लिए नया ये ग्रोथ ट्रिगर बन सकता है.
Okay.
रिस्क फैक्टर्स रिस्क फैक्टर्स वो स्लो डाउन इन माइनिंग और ये हैजर्डस सेक्टर में काम करता है, तो ये रिस्क फैक्टर्स हैं।
राइट, ओके, ठीक है ना। तो आप बोल रहे हो कि इसके अंदर कोई प्ले है क्या, मतलब जो, मतलब माइनिंग तो आई थिंक इट हैज बीन लॉन्ग डूइंग, राइट, एंड मेनली एक ही प्रॉक्सी है, कोल इंडिया एंड देन सोलर इंडस्ट्रीज व्हिच इज अ बिगर ब्रदर इन दिस इंडस्ट्री। तो परलाइट के अंदर आर दे वर्किंग ऑन सम इंटरेस्टिंग प्रोडक्ट जहां से इनकी रेवेन्यू
हाँ,
ग्रोथ फास्टर हो सकती है?
परलाइट में क्रायोजेनिक इंसुलेशन प्रोडक्ट ये बनाता है और इसका टेक्नोलॉजी भी ये प्रोवाइड करता है। तो इसका यूज है कि लो टेम्परेचर पे जो हैंडलिंग के लिए एलएनजी हुआ, ब्यूटेन हुआ, ये सब को हैंडलिंग और ट्रांसपोर्टेशन में इसका यूज होता है। तो ये ग्रोथ ट्रिगर बन सकता है इसके लिए।
Got
और
it.
एक्सप्लोजिव का डेटोनेटर्स और फ्यूज भी ये बना रहा है। ये इसको इंटरेस्टिंग बनाता है ये सब।
Got it. Yeah. Interesting. We'll study this company. Yeah. Next one is Mithun ji.
Hi, can you hear me?
Yes, you are audible.
So I wanted to present a company called Lokesh Machines. I'm gonna keep it short. Over here, the Lokesh Machines is basically a CNC producing company, but it is going through. The story is basically this company is going through a downfall because it used to export certain products to Russia, and as a result, the U.S. Treasury Department, which has a specific office called Office of Foreign Asset Control, has resulted into a restriction that you should not deal with Lokesh Machines. So this happened in the month of October 2024. We can go through the quarterly results over there. We can see till September, everything was looking good. The net profits, the operating profits were going on increasing trend. But on December, the profits dropped. The operating profit dropped directly from 12 to 0.98, and they are trying to recover it. But still, the reason behind that is their major clients who used to deal with the Lokesh Machines, they backed out. One of the major clients was Mahindra and Mahindra, and all their new machines, as in new cars, were supposed to have Lokesh Machines products, but they backed out because they wanted to sell their products in foreign countries and they don't want any restriction to happen on their products. So within that, there are multiple other clients, they backed out. So as a result, the operating profit started falling down. But at the same time, they did a heavy expansion to get these clients, as in which backed out. As a result, there was an increase in the debt, as well as there was asset increase, but and there was an increased depreciation also. So this resulted in a double whammy: the clients going out, the profits falling because of the higher interest cost, higher depreciation. The good thing is Lokesh Machine understood that, and they have taken certain steps which leads to diversification of more clients, getting more other countries which does not deal with the US restriction as such. As a result, the profits are now increasing. But still, if at all we consider the latest results, shows around mere profit of very single digit numbers, which used to be at 500 something like that as a numbers. Let me just cross check the numbers. Okay, so let's say for the half year ended 30 September 2024, so the revenue from the machinery component was 1,183, and the components department was 814. These are in lakhs. Now in this year 2025 till September, the half year ended, the machinery division is reflecting 1,421 lakhs of profit, and the component division is reflecting only 16 lakhs as a profit. There's a huge difference of, let's say, 780, not 800, approximately 800 crores or 800 lakhs of profit is completely down. It's not there because the component division is not reflecting those good profits. So the only thesis over here is, because it's going to a downfall, the thesis is the promoter has been issuing in warrants at the rate of 233.35, which is higher than the current market price. And he is doing it recently, as recent as last 2 months back. Multiple warrants has been issued. He's infusing capital so that he can reduce the debt burden and has this company going in a going concern way. And the second thing which we can play in a way where we can take, let's say somebody wants to take a bet. So the bet would be like buying 100, if at all he wants to buy the whole 100 shares, so he will buy 10 shares as a tracking position. As soon as this OFAC restriction is removed, because they are fighting in US, that they were selling the products to this Russian company since 2011. So it's very incorrect to give them a ban, because they are saying that since 2023 they are selling. It's from 2011. All this data is there available in the documentations. So if at all they get this true, so the next quarter will have a very good profits, and it will be like showing very excellent numbers, and that time you won't able to catch. So take a tracking position. As in, what I'm doing is I'm taking a tracking position in here. As soon as there is any restriction being removed, then that is the point where it will show very excellent profits in quarterly results, because they have informed in Arihant Bharat conf call also that they Mahindra and Mahindra is still waiting. So because they have also invested in their capex. So Lokesh Machines created that additional capex using their money also, Mahindra's money, and their own money. So as soon as that is removed, then Mahindra will come in again, and this will definitely be a good quarter in that way. So that's what my thesis is. You can track another company called Galaxy Bearing, which are in the same. They also got the same restriction. So as soon as you get a news of OFAC being removed from Galaxy Bearing, you can play via Galaxy Bearing Lokesh Machines also. So that is the same thesis, because they got the same restriction in October 2024. So that's the thesis, and that is what I have kept it small. Rest of the things are pretty much simple. Whatever the Lokesh machine does, the similar products are being done by MacPower CNC or Jyoti CNC, basically CNC machines, and each one has their own specification. So Lokesh machine went into defense. They are the company who is producing, which are producing the guns. So they started with the small guns, which is more like, I don't know, as in so they have a product which is more similar to Uzi, and they have went into low machine guns, and now they are going for heavy machine guns. So they are doing very good in defense, and there are very few companies in defense who are producing these kind of machine guns and these kind of products. But the major margin comes from the machine components, which is dying down right now.
Got it. Yeah. Right. Interesting company to keep on radar, certainly. So what is the probability of moving out of the sanction that USL faced? Like, are any bigger group helping them?
So there's no such bigger group helping them out, but they are very, as in, so they have filed the cases, as in both Galaxy as well as Lokesh Machines, and they are optimistic, but they can't give any timelines that whenever the restriction is getting removed or not. So I expect this should happen as soon as the trade deal happens. After the trade deal goes through, within 1 or 2 months, it should go through.
Okay. So this happened. So the reason happened for the Russian thing, right? Because
Yeah.
US
They were selling products to Russian companies, not the guns, but certain components which were used in some defense tools.
Okay.
So that was all for today. Thanks for the very, very hearty participation. First of all, hearing out for 2 hours and then having the patience to share your ideas. We would like to certainly form an engaging community because we will have lots to present and lots to discuss, and certainly look at collective wisdom. With my experience of more than 2 decades in the market, I have always felt that there are certain ideas, whatever scanner you use, you cannot end up having, or rather you miss them, simply because any number of members that you have in the team, it is not possible to do a deep dive into so many businesses and also have a clear understanding of where it is going. It is very easy to diagnose a business from the past. It's not easy to make an assessment where it will go for 2 years. So with that objective, we are having this annual membership, and certainly it will be have physical meetups as well, as we understand where the members' geographies are. But certainly meeting at least once a month is on the cards, and I think let us all grow our wealth together. Over to you, Manthan.
Yeah, 100% agreed. So that's the motto behind it, and so we are trying to club a lot of value that we can bring from our end. So all the sectoral webinars and meetings, and then guest lectures will also be very interesting. And this will be only exclusive to our investing club members.